Morning, students.
Good morning.
So, if I'm not mistaken, I completed chapter 3 with you in the last lecture. Okay. Only that BPR concept is to be explained here. Now, BPR is actually something that we need to know after we study target costing. But target costing is the next topic that we are going to do. So, let me start by giving you a brief introduction as to what is target costing, and then I will come to BPR. So, target costing is where, let us say, I am coming out with a new product in the market. For me, the product is new because I'm manufacturing it for the first time, but product is already available in the market. For example, let us say that I want to manufacture and sell mobile phones. For me, it is a new business, but mobile phones are already there in the market. So when I come out with such a product, the question is, what should be the pricing? What should be the amount that I should charge to my customers? Now, the amount to be charged to my customers, if I charge a higher amount than the market price, then customers may not buy because I'm a new person in the market. If I charge less than the market price, then I may lose out on profits that I could have earned by charging a higher price. So, what should be the market price at which I should be selling the goods? To understand that, I will go to the market, conduct a survey, and find out similar mobiles which are available in the market at what price they are selling. And I get an idea as to what is the price of the mobile that I should be fixing for my product. Let us say I come to an understanding of the market and I understand that around 17,000 would be a good figure. Okay, so 17,000 rupees for one piece of mobile is the price that I've agreed upon. Now I want a 20% profit margin. So 20% of 17,000 will come to 3,400. So I will say that, okay, 3,400 is my profit margin. So what should be the cost? What should be the cost? That cost should be 13,600. Okay, so 13,600 is my target cost, within which I should be able to manufacture and sell my product. So I tell my production manager and my cost accountant that I want to manufacture a mobile phone which is going to have a selling price of 17,000, but the cost should not exceed 13,600. That is my target cost. So how did I arrive at my target cost? It was target selling price minus my target profit is equal to target cost. Okay. Now, my production manager sits down with my cost accountant and he tries to find out what raw materials will require, what labor costs will be incurred, what overheads will be incurred. And then he comes to the conclusion that, okay, this is going to be the total cost of the manufacturing of a mobile. But the cost is coming to 15,000. Whereas I want the cost to be not exceeding 13,600. He says that, sir, cost is going to be 15,000. We can't manufacture the mobile that you want to sell in the market at 13,600. So I tell him, go and rework again and see if you can reduce the cost anywhere, make some adjustments, bring out some cost reduction, cost control, and see if you can bring down the cost from 15,000 to 13,600, because I cannot sell more than 13,000. I cannot afford to have a cost more than 13,600, because then my profit margin is going to decrease. So again, they set to work and see where they can adjust, where they can reduce the cost, where they can control the cost. Still, they say that, okay, they come back to me the second time and tell me, sir, maximum we can reduce 500 rupees. So cost will be 14,500. Still, my target cost of 13,600 figure is not met. So what to do now? So the last option available for me is BPR, Business Process Reengineering. What is business process reengineering? Process reengineering. So I'm talking about re-engineering the process, reworking the process. So what do? I go to the market, I purchase the mobile of my competitor who is having a mobile manufactured and sold at 17,000 with similar features that I want to put in my product. I purchase that mobile for 17,000. I come back to my factory. I open the mobile and see what are the parts over there. So I'm trying to now rework. That means rework my cost by going in the reverse order. Product is there. Now I'm going in the reverse order, trying to break up the product and find out what are the components, what can be the estimated labor cost for this, from where the parts are manufactured or from where the parts are purchased, and accordingly I will also try to manufacture on similar lines. So I may have to change my production process also. I may have to change the design of my product also. So these things I want to know. So I purchase the product, split open the product, and try to analyze what is there in that product, so that I can also have the same parts, similar parts, so that my cost will be reduced to 13,600. That, in short, for a common man, is called as business process reengineering. Okay. Now let us see the technical definition of this. BPR refers to the fundamental rethinking and redesigning of business processes to achieve improvement in critical measures of performance, such as cost, quality, service, speed, and customer satisfaction. In contrast to the Kaizen costing, what is Kaizen costing? Continuous improvement, small improvements, which involves small incremental steps towards gradual improvement. BPR involves a giant leap. That means it is the opposite of it. That means overnight I want to set up my plant, which will help me to manufacture the product at a particular target cost. Okay, so that is BPR. It is a complete redesign of a process with an emphasis on finding creative new way to accomplish an objective. What is the objective? My target cost. So I want to ensure that the cost does not exceed that figure of 13,600, my target cost. So that is the objective. So it is a complete redesigning of a process that we are having for a product. Okay, and trying to ensure that my objective, what is my objective of target cost, is achieved. So I can say that this is a summary of the entire discussion that we were having. It is like starting from scratch and redesigning an entire process. It starts with the top management with the corporate vision, targeting customers, trying to improve the systems and procedures to achieve this, increasing the clock speed of the organization. That means I want to do it fast. Drill down thinking process for each vital element of the organization, like personnel, structural design, drawings, raw materials, etc. avoids unnecessary work, demolishes obsolete methods and systems if required. BPR takes care of all the facets of operation in an organization. It gives stress on management system, social system, and behavioral system. That means when I take a product and break it down and try to find out what are the features of the product, what are the components, and why the consumer is paying such a price for that product. Why is he paying 17,000? What is it worth for? What are the customers looking at? What do they desire? So when I look at all these things, it is like I'm looking at management system, social system, behavioral system. Okay. Then steps involved in BPR, determining the objective and the framework, identifying customers and determining their needs, studying the existing process, okay, and formulating a redesigning process plan and implementing the process. So that is basically your steps or 5 steps for redesigning a process, BPR. 7 principles of BPR may or may not ask, but steps are important. Concept of BPR is important, steps are important. 7 principles, processes should be designed to achieve a desired outcome rather than focusing on the existing task. Personnel who use the output from a process should perform the process. Information processing should be included in the work. That means what is required by the customer, what is desired by the customer. Existing product may not have those features, so you need to incorporate those features. Geographically dispersed resources should be treated as if they are centralized. Parallel activities should be linked rather than integrated. Doers should be allowed to be self-managing and information should be captured once at source. So these 7 principles are there. You may need not study all of them by heart, but at least the 5 steps of business process reengineering that should be known. The concept of business process reengineering and the 5 steps. Okay. So that is the background of BPR. And in that process, I've also explained to you what is the target costing all about. Now let us come to the basic objectives of cost management and cost accounting. Because we are going to do cost management techniques now. As I told you, techniques are something which can be implemented in any type of business. Methods of costing can be employed only in particular industries. But techniques of costing can be implemented in any industry, right? So in this topic, we are going to learn the techniques of cost management. New techniques, not the old ones, new techniques. The old ones are standard costing, marginal costing, budgetary control. That is as per traditional costing. But as per the lean system of costing, the new method of costing, what are the new methods, the new techniques of costing that we have to learn. Okay. But basically, the objective is what? Cost control, cost reduction. So, what is cost control? That we have said. It is defined as the guidance and regulation by executive action of the cost of operating an undertaking, the cost of running a business. That is cost. Cost control, regulation and guidance required for implementation of cost. Cost control plays its part at the discretion of the management who wish to maintain the cost within a specified limit. It is exercised through numerous techniques, some of which are budgetary control, standard costing, inventory control, etc. It aims to improve the performance or efficiency to achieve the target cost. So you can see that ultimately we are coming to the objective here to achieve the target. Cost control can be ensured through setting up standards. So we are talking about the traditional methods, setting up standards for expense and production, finding out differences of actual selling standards. So this is nothing but the variances that we calculate. Analyzing the differences, analyzing the variances with why the variances came into existence. For example, there is a difference between standard cost and actual cost. So what is the difference? It may be that quantity is differing. It may be that quality is differing. So because of that, we are having difference in the cost. And then taking corrective measures to eliminate the variations. Okay, so that is somewhat similar to standard costing that we do. Then we have the cost reduction. Cost reduction is concerned with reducing the cost. Concerned with the reduction program, which is a continuous process. Now, here you have to mention reducing cost without affecting quality or without reducing quality. It is concerned with reduction program, which is a continuous process. It strives to achieve permanent reduction. Starts where cost control ends. Where cost control ends, cost reduction starts. So cost can be reduced on account of savings in cost, advantages they have given. But basically, they will ask you the difference between cost control and cost reduction. Cost control is the guidance and regulation by executive action. Cost reduction, it is the achievement of real and permanent reduction. Okay, cost control is temporary, you can say. Cost reduction is permanent. So this is the word which is important. Permanent reduction. Second is emphasis. Cost control emphasizes on the past performance and variance analysis, traditional costing. Cost control, that is cost reduction, is going to emphasize on present and future performance without considering the past. So this is emphasizing on past performance. Cost control is a conservative approach. Cost reduction is a dynamic approach. Focus is short term. Here the focus is long term because it's permanent. It's long term. This is a preventive function. This is a corrective function. So the differences between cost control and cost reduction will be asked in the examination. Let us come to target costing. Target costing is defined as a structured approach to determining the cost at which a proposed product, that means you are not yet manufacturing the product, you are in the process of starting a new production line. Proposed product with specified functionality and quality must be produced to generate a desired level of profitability at its anticipated selling price. So we start with the anticipated selling price, minus from that the anticipated profit or profit margin, and then arrive at the target cost. So you can say that target costing is driven by external market forces. Why? Because we start with the market first. We start with the market price. What is the market price? What is the customer willing to pay for the product? That is from there we start. So it is driven by market forces. Marketing managers first estimate the performance characteristic and market price requirements in order to achieve a desired market share for a proposed product. A standard profit margin is then subtracted from the projected selling price to arrive at the target cost for the project. So I can say that target cost is equal to target selling price, or you can say market price, minus estimated profit margin or target profit margin. Okay. Here we have divided this into two parts, stage 1 and stage 2. Stage 1 is driven by customer, market and profitability considerations, and stage 2 focuses on cost reduction. So let us see, because there are some points which will be overlapping in certain cases. Let us start with stage 1, which is driven by customer, market and profitability considerations. In that, the first step is the product design specification. So once we know what is the target selling price, what is the profit margin that we require, the desired profit margin as required, and we have arrived at the target cost, then in that case, where do we start with? We start with the product design. We go to the basics. We start with the product design. Design specification for the new product or for modification of existing products, which are based on customer taste, preferences and expectations. Products are available in the market. Similar products to what I want to manufacture are available in the market, but customers may not be 100% satisfied. Now, to give them the 100% satisfaction, what should be done? What is the additional requirement of customers? That should be incorporated in my design of the product. Customers' requirements regarding the functionality and quality of the products is of prime importance. Competitors' products and the need to have extra features over the competitors' products is also considered. Providing improved products without increasing the price should be recognized. Second and third step, target selling price and production volume. Target selling price means what is the selling price that I want to sell my product at, which will be the market price. Using various sales forecasting techniques, Second, selling price is also influenced by the offers of competitors, product utility, volumes and margins. Third, in view of competition and elasticity of demand, the firm has to forecast the price volume relationship with reasonable certainty. Hence, target selling price is market driven. Target selling price is market driven. Establishment of target production volumes is closely related to target selling price given the relationship between price and volume. Target volumes are also significant in computation of unit cost. How much you are going to sell? What is the market segment that you want to capture? You want to capture 80% of the market, 60% of the market, 20% of the market. What is the market that you want to capture? Depending upon that, you will decide number of units that you are going to produce and sell. Okay. Step number 4, target profit margin. Since profitability is critical for survival, a target profit margin is established for all new products. Again, keep in mind, new products. Target profit margin is derived from the company's long-term business plan, objectives, and strategies. What is normally your profit earning capacity? 20%, 25%, 15%. So on the basis of that, you will decide your desired profit. Each product or product line is required to earn the target profit margin. So these are the 4 steps in the first stage, which is market driven. Second stage is cost driven. That means reducing the cost. So stage 2, step 5, or the first step in stage 2, setting target cost. Difference between target selling price and target profit is the allowable cost for the product. So target cost, another name for target cost, is allowable cost. Another name for target cost is allowable cost. Ideally, the allowable cost becomes a target cost of the product. However, sometimes the target cost may exceed the allowable cost in light of the realities associated with existing capacities and capabilities. So alternate names you have to know, because sometimes in the problem they make use of alternate names. Like they will not use the word target cost. You will say calculate the allowable cost for the product. So allowable cost is nothing but target cost. Okay. So different terms are used. For example, in types of cost, we said that we have fixed cost and variable cost. What is another name for fixed cost? Plastic. Another name for fixed cost? Yes, Satvika. Another name for fixed cost? Forgot. Fixed cost is also called as period cost, no? Yes or no? Because why it is called period cost? Because it is fixed for a particular period of time. What is variable cost called as? What is variable cost called as?
Product cost.
Product cost or production cost. Okay. Now, one more thing, one more attribute, one more characteristic of fixed cost and variable cost. Or one more attribute of cost, not only fixed cost and variable cost, but cost in general. Manufacturing cost that is there. Okay. Manufacturing cost that is there. Direct materials, direct labor, and manufacturing overheads, fixed as well as variable. Okay. Understand my question. Direct materials, direct labor, and manufacturing overheads, fixed as well as variable, is also called as what? Production cost is one of the terms, but it is not called production cost. It is also called as what? Direct labor, direct materials, as well as manufacturing overheads, fixed as well as variable. What is it called together?
Cost of production.
No. It is also called as inventoriable cost. Inventoriable cost. What is the logic? The logic is that when I have inventory of finished goods, what are the costs that are included in that inventory of finished goods? It's direct material, direct labor, manufacturing overheads. Normally, administrative overheads are not considered as a part of inventoriable cost. Okay. What is administrative cost, selling cost, and distribution cost known as?
Cost of sales.
No. Admin cost, selling cost, and distribution cost. Together is called as what? Together it is called as dash cost. What is the dash? Fill in the blank. Admin, selling, and distribution overheads are together called as dash cost. Yesterday I was asking this in the class. So some smart students now they started Googling. And Uncle Google did not also have an answer for this. So Google is not cost qualified. Anyway, administrative, selling, and distribution cost is also called as expendable cost. So sometimes when you use these words in the question, in the problems, you should know the meaning of this. Inventoriable cost is cost up to manufacturing. So that is your direct material, direct labor, direct expenses, variable and fixed manufacturing overheads. All that is a part of your inventoriable cost. What goes into the inventory? What goes into the cost of finished goods which are stored in the godown? That is inventoriable cost. We also call it as, in foreign books, they call it as capital cost. Why they call it as capital cost? Because capital cost means it is capitalized. Capitalized where? In the balance sheet. Okay. So material cost that you are incurring, that you are consuming, the labor cost that you are consuming, all that is going in the balance sheet. It is a capitalized cost. It adds to the inventory. Fine. What about administrative, selling, and distribution expenses? They never come in the balance sheet. They are never taken in the part of closing stock of finished goods. So they are shown where they are debited to profit and loss account. They are expendable cost. They are shown as expenditures. Why they are called as expendable cost? They are shown as expenditures. Okay. So that is, these are the things that you have to look out for. Alternate terms which can be used in the question. So as I said, target cost, another alternative term for this is allowable cost. Manufacturing cost, another term for this is inventoriable cost. Administrative, selling, and distribution, another term for this expendable cost. Okay, so target costs are also called as allowable cost. That is the cost that you can allow to be incurred. That is the maximum that you are going to allow to be incurred because you want a desired profit margin. Okay, so ideally the allowable cost becomes a target cost of the product. However, sometimes the target cost may exceed the allowable cost in light of the realities associated with existing capacities and capabilities. Suppose you want to come out with a superior product, a different quality product, a high-end product, then maybe that the target cost may exceed the allowable cost. Then step number 6, computing the current cost. So first you find out what is the target cost. Then you find out what is the current cost. Okay, current cost, as I give you the example, I wanted that the cost should be something around 13,600. Okay, I wanted it to be 13,600. But computing current cost, the production manager came and told me that, sir, it is not going to be 13,600, it will be 15,000. So calculating the current cost for the product based on existing technologies, components, etc. Okay. Direct costs are determined by reference to design specifications, material price, labor processing time, wage rates. Indirect costs may be calculated based on activity-based costing, ABC. So calculate the current cost, and we came to the conclusion that current cost is going to be 15,000. Next step is setting the cost reduction targets. Now I told the production manager what, that we can't have this. We can't have 15,000. We have to reduce it to 13,600. So third step is setting the cost reduction targets. So from 15,000 we have to come down to 13,600. So this is called as a cost gap. Cost gap. Okay, target cost gap or simply cost gap. So what is cost gap? Cost gap is the difference between target cost and current cost. Okay, so difference between current cost and target cost indicates the required cost reduction. So I will call this as cost gap. This account may be divided into two parts: target cost reduction objective and strategic cost reduction challenge. The former is viewed as being achievable objective. The latter acknowledges current inherent limitations because it's a challenge to reduce the cost to what target I have set. Becomes sometimes very difficult. So sometimes, I'm told you have to complete the portion within 70 hours. I say it is not possible. It's a challenge to complete within 70 hours. It's not possible. Target, yes, 90 hours you give me, I can complete. But 70 hours, it's not possible. Okay, so it is a cost reduction challenge. So for me, it is a time reduction challenge. After analyzing the cost reduction objective, a product level target cost is set, which is the difference between current cost and target cost reduction objective. Last step, identifying cost reduction opportunities. And this is where value engineering comes into play, where we have discussed what is the concept of value engineering. That is dividing all the activities into two groups: value-added activities, non-value added activities. Non-value added activities further classified into essential and non-essential, eliminating the non-essential part of non-value added activities, minimizing the non-value added activities which are essential. So this is nothing but cost reduction opportunities with the help of value engineering and value analysis. Okay. So that is these are the 8 steps for target cost. Okay. Now here what is going to happen is, in the examination, they ask you questions. They ask you questions on impact of target costing on different aspects. So all these parts which are there, where I'm writing here impact, that is important for examination. The first is impact of target costing on profitability. Second is impact of target costing on industry suitable. Okay. So these are the things that you have to look out for. Impact of target costing on profitability. How it is going to impact? In two ways. First, assured profit by constant review. Target costing places continuous emphasis on product cost throughout the life cycle. Management is fully aware of costing issues since it receives regular monitoring and review reports. So, as I said, you go to the market, find out the market price, 17,000. You say, I want 20% profit. So 3,400. So assured profit of 3,400. Once you are arriving at your target cost, assured profit of 3,400. Okay. Price determination and consequent price control. Target costing improves profitability through precise targeting of the prices at which company can market a profitable product. Thus, target costing results in better cost control and also in better price control than the traditional cost plus approach. Okay. So this is one more thing that is important here. Target costing is part of a larger concept called concurrent engineering. Okay, concurrent engineering, which requires participants from many departments to work together as project teams. And this is a part of BPR, business process engineering. Okay, so I'll give you 5 minutes, go through the entire theory, and we can start with the questions. gone through? Let us take up the questions. Page 78, question 1. First, we'll take up simple questions, then we'll take up the examination related questions. Desktop company manufactures and sells 7,500 units of a product. The full cost per unit is 100 rupees. Company has fixed its price so as to earn a 20% returns on an investment of 9 lakhs. So what is the expected return? Expected return is 20% of 9 lakhs. 20% of 9 lakhs will be 1,80,000. Required. Calculate the selling price per unit from the above. Also calculate the markup percentage on the full cost per unit. Second, if the selling price as calculated above represents a markup percentage of 40% on variable cost per unit, calculate the variable cost per unit. Okay, so let us start with the first one. Returns on investment required is 1,80,000. Calculate the selling price. Total cost they have given us 100 rupees. Returns on investment required is equal to 20% of 9 lakhs. That is 1,80,000. Returns per unit $1,80,000 is the total profit or returns required on 7,500 units. So that will come to 24 rupees per unit. Therefore, selling price is equal to total cost plus desired return total cost is 100 rupees. Desired return is 24. So selling price is 124. Markup percentage on cost is equal to 24 by 100 into 100. That is 24%. Second part of the question, what are they asking us? if the selling price is calculated above, that is 124, is representing a markup of 40% on variable cost per unit. That means 124 selling price that we have calculated is 40% plus the variable cost. Markup of 40% on variable cost means what? Variable cost plus 40% is equal to 124. Then calculate the variable cost per unit. So it is like this: variable cost plus 40% of variable cost is equal to 124. So what is variable cost? That is what we are asking. Clear? Okay. So if the selling price as calculated above, that is 124, is nothing but 140% of variable cost. Markup of 40%. What is 40% of variable cost? Then what is the variable cost of? So let us write to solve. If selling price rupees 124 represents markup of 40%, markup of 40% on variable cost, then variable cost plus 40% of variable cost is equal to 124. So variable cost plus 40% I can write as 0.4 variable cost. So 1.4 variable cost. So variable cost is equal to 88.57 per unit. Point is clear? So a simple question. They are asking us to calculate the variable cost. If the selling price of 124 is calculated by taking variable cost plus 60-40%. Okay. Let us take the next question. Question number 2. ABC Enterprises has prepared a draft budget for the next year as follows. Quantity is 10,000 units, selling price per unit is 30, variable cost per unit, direct material 8, direct labor 6, variable overheads 2 hours at 0.5 per hour. That will be 1 rupee per unit. Per unit is 1 rupee. Per hour is 0.5. Contribution per unit is 15. Budgeted contribution 1,50,000, budgeted fixed cost 1,40,000, and budgeted profit is 10,000. What's the question? The board of directors is dissatisfied with this budget and asks the working party to come up with higher target profit figures. So this 10,000 that they have got as profit, which is 150 minus 140, they are not happy with that. They want a higher level of profit. The working party reports back with the following suggestions that will lead to the budgeted profit of 25,000. So instead of 10,000, we are saying that we can have a profit of 25,000. But for that, we have to incur additional expenses. What? 25,000 on advertising and set the target selling price to 32. Now the selling price is 30. So they are saying let the selling price increase to 32. let the selling price increase to 32 from 30, and we will incur 25,000 more on the selling and administration expenses. What will happen because of that? Because of that, the sales volume will increase and it will increase to 12,000 units. Will say, sir, selling price has increased. They are saying in spite of increase in selling price from 30 to 32, the production and sales will increase from 10,000 to 12,000 units. The original figure of production and sales is 10,000. It is going to increase to 12,000. So what we require is change in selling price from 30 to 32. Increase in profit will take place to the extent of 25,000, provided we incur additional 25,000 on advertising, which will guarantee us an increase in volume of sales from 10,000 to 12,000. Now, in order to achieve the extra production capacity, meaning from 10,000 we are increasing production capacity to 12,000, the workforce must be able to reduce the time taken to make each unit of the product. It is proposed to offer a pay and productivity deal in which the wage rate per hour is increased to 4 rupees. Wage rate per hour is increased to 4 rupees. Now, existing, how much is the wage rate? Existing wage rate is how much, Swastik?
Labor cost of that 6 rupees per unit. Sir.
How much?
6 rupees per unit. Sir.
Wage rate is always calculated on hourly basis, because here we have said it is increased to 4 rupees per hour. So 6 rupees is per unit. How many hours per unit? 2 hours. So 6 divided by 2, it is at what rate? 3 per hour. Am I right? Okay. 6 rupees per unit, but per unit we require 2 hours. Wage rate per hour is 6 divided by 2, so it is 3 per hour. That is now going to increase to 4 per hour. The hourly rate for variable overheads will be unaffected. What is the hourly rate for overheads? 0.5. So that will remain 0.5. But what is the question? Question is not asking for target cost. Question is not asking for target cost. What is the question asking? Ascertain the target labor time required to achieve the target profit. So read the question properly. It is not always target cost that will be asked. Here they have asked you average labor time, the target labor time that should be there to achieve the target profit. Target labor time required. Be careful in drafting your answers. So they have given that labor rate is going to increase from 3 rupees per hour to 4 rupees per hour. Overhead rate will remain the same at 0.5. They want you to calculate the aggregate time. So can you tell me what will be the average time required for achieving the target profit? Calculate and tell me. See if you can do it. I will require time per unit and the total time. Both I will require. Calculate both and tell. Time per unit and total time required. you have got the answer, put it in the chat box. Labor cost per unit, total labor cost. Chartered accountants are normally appointed for reducing the cost, not for increasing the cost. Yes, Satvika, answer.
Sir, I'm unable to write it in chat. Sir, is it rupees 8 per unit and rupees 96,000 for 12,000 units?
Per unit figure is wrong. It is very high. Swastika has given 4, that also is rejected. They have given higher than that. Akhilesh, labor cost is not required. Labor time is required, not labor cost. We require labor time. We require it in number of hours. That's labor time. Okay, now let us see what is the thought process that should be used here to start with the problem. As some of the students, they say that, in costing, it is difficult to know what is the starting point. So let us try to see what is the starting point of the problem. They have given me that variable overheads, in the variable overheads, material cost is not going to change. Implied. They have not given the revised figure, so it is implied material cost is not going to change. Labor cost, they have said from 3 rupees, it is going to increase to 4 rupees per hour. So I know the labor cost per hour. I know the variable overheads per hour, 0.5. Okay. But that per hour, how many hours are required for 1 unit? That is what I want. Which means that if I take the number of hours as X, I can get X hours per unit. So if I take 4 into X, I'll get 4X as the labor cost of 1 unit. If I take 0.5 into X, I will get variable overheads per unit as 0.5X. So 4X plus 0.5X will give me 4.5X, which is the combined cost of labor and overheads per unit. So 4X plus 0.5X, 4.5X plus 8 material cost, is going to give me total variable cost. So I can get an equation if I know what is the variable cost. What is the equation? 4.5X plus 8 is equal to whatever is the variable cost. Now I do not know what is the total variable cost going to be, but I can calculate. What is the variable cost? Now again, what is the concept here? Target cost. What is the topic? Target cost. So I should know what is the target variable cost. Okay. So to know the target variable cost, what should I know? I should know target selling price and I should know target contribution. Correct now? If I get target selling price and I get target contribution, selling price minus contribution will give me what? Target variable cost. Okay. So now that is a way we work out. We think as to how to start the problem. So I require target selling price, which I know 32 rupees. I require the target contribution, which I don't know, which I have to calculate per unit. Okay. So as of now, the target profit that is desired is 25,000. Okay. So I will calculate. How to calculate contribution now? Target profit do I know? How to calculate target contribution? Target contribution from the profit. How to calculate contribution? Profit plus fixed cost will give me contribution. Right? Selling price minus variable cost is contribution. Contribution plus fixed cost is profit. So if I'm going in the reverse order, profit plus the fixed cost will give me the contribution. Right? So right now, target profit is 25,000. Target profit is 25,000. Plus the fixed cost. I'm going to incur fixed cost, existing fixed cost, 1,40,000. That is not going to change. Existing fixed cost, 1,40,000. Plus additional advertisement cost, which will also be the fixed cost. That is of 25,000. So total contribution is 1,90,000. increased sales volume will be 12,000 units. Therefore, target contribution per unit is equal to 1,90,000 divided by 12,000. How much is that? 15.83. Correct, no? 15.83. Target selling price 32 minus target contribution 15.83. So target variable cost 16.17 total variable cost per unit is equal to material cost per unit plus labor cost per unit plus overhead cost per unit let number of hours, number of labor hours per unit equal to X equal to X. So total variable cost is 16.17, material cost is 8, labor cost per unit 4x, overhead cost per unit 0.5x. $16.17 minus 8 will give you 8.17. So 4.56x, 4.5x is equal to 8.17. So x is equal to 1.82 hours per unit. Therefore, for 12,000 units, the total labor hours will be 12,000 into 1.82. So total hours will be 21,840 hours. Done. We'll take a break of 10 minutes and then we'll return. 10 to 15 minutes, whatever you want. You can go and have a cup of tea and come have your breakfast. 15 minutes will be sufficient. So 15 minutes break, it is 9:22. We'll start at 9:35. So shall we start? Let us come to question number 3. You are the manager of a paper mill, M Limited, and have recently come across a particular type of paper which is being sold at a substantially lower rate by another company, ABC Limited, than the price charged by your company. The value chain for 1 ton of such paper for ABC Limited is as follows. Value chain is the chain of activities that go on from the supplier up to the final customer. So the case of ABC Limited, it is ABC Limited will be selling the goods to the merchant. Merchant will be selling it to the printer. Printer will be selling it to the customer. ABC Limited sells this particular paper to the merchant at 1,466 per ton. ABC Limited pays for the freight, which amounts to 30 rupees per ton. Average returns and allowances amount to 4% of sales and approximately equal to 60 rupees per ton. Value chain of your company, that is M Limited, through which the paper reaches the ultimate customer, is similar to that of ABC Limited. However, your mill does not sell directly to the merchant. ABC Limited is directly selling to the merchant, but your mill is not selling directly to the merchant. The latter receiving the paper from a huge distribution center maintained by your company at Haryana. So what is your chain, supply chain? M Limited to distribution center to merchant, merchant to printer, printer to customer. Okay, so that is your supply chain. So you have to know the 2 supply chains. ABC Limited you have given to you. So ABC Limited, this is the supply chain. For M Limited, it is M Limited will be giving this to a distributor or a distribution center. This distribution center then gives it to the merchant, merchant to printer, and printer to customer. This is your supply chain. Shipping cost from the mill to the distribution center amounts to 11 rupees per ton, while the operating cost in the distribution center has been estimated to be 25 rupees per ton. The returns on investment required by distribution center for the investment made amounts to 58 rupees per ton. This is the returns required, estimated returns by the distribution center. You are required to compute, read the question properly. You are required to compute mill manufacturing target cost for this particular company, for your company, for this particular paper, for your company. You may assume that the returns on the investment expected by your company equals to 120 per ton. Returns on investment expected by your company, that is by M Limited, is 120 per ton. What is the expected return of distribution center? 58 rupees per ton. That is not your expectation. Your expectation is 120 per ton. So the mill is different from the distribution center. The mill is different from the distribution center. Okay. So we want to know what is the cost for M Limited. Okay. We want to know what is the mill manufacturing target cost. What is the mill over here? M Limited. So we want to know what is the target cost for M Limited. So how do we go about it? As I said, for target cost, we require to start with target selling price. Target selling price market is what is the selling price of ABC Limited. So that is the only competitor there. So ABC Limited target price is what? Selling price 1466. From that, you have to minus the 30 rupees freight. From that, you have to minus the returns and allowances 4% of sales. Okay, and approximately equal to 60 per ton. So 4% of sales, 60 per ton has to be subtracted. So from 1466, you have to minus the freight of 30, you have to minus the returns of 60. Okay, what will you get then? You will get the target selling price of ABC Limited. That is the target selling price of ABC Limited, or you can say net selling price of ABC Limited. Minus from that, now ABC Limited is selling prices over here at what it is selling to the merchant. But for us, we will get selling price where at this price. So 1466 minus 30 is 1436. 1436 minus 60 is 1376. 1376 is the price which the distribution center will be selling to the merchant of our company. Okay. So minus that. So this is the, you can say 1376 is here. That is a target selling price for distribution center, not for M Limited. So to arrive at M Limited target cost, what do I have to do? From this 1376, whatever is the expected returns by M Limited, sorry, by distribution center. What is the distribution center returns expected? $120. Distribution center, oh sorry, distribution center expected is 58. Okay, and what is the returns expected by the company M Limited? 120 per ton. Okay, so what is going to be the mill manufacturing cost? So mill manufacturing cost is M Limited. What I've got over here is the M Limited plus distribution center 1376 target selling price. Okay, so target cost will be 1376 minus the 120 rupees that we are having of the company. 120 rupees of the company. Fine. Now from that, we have to minus shipping cost of M Limited distribution center, which is 11 rupees. Operating cost of the distribution center, which is 25 rupees per ton. And the returns expected by the distribution center, that is 58 per ton. When I minus all these things, I will get the target cost of manufacturing, target manufacturing cost. Okay, so that is the sequence in which I'm going to do it. So let us start with target selling price. Right here, computation of mill manufacturing cost. Starting with selling price of ABC. 1,466 minus freight paid by ABC Limited. ₹30 minus returns and allowances. ₹60. So I have 1,376 minus returns required by M Limited. $120 that is target cost of mill and distribution center. $1,256 minus shipping cost incurred by mill ₹11 minus operating cost at distribution center ₹25 minus returns expected by distribution center this is target mill manufacturing cost. $1,162. Okay, so this is the type of question you can get for 4 to 6 months. Now let us come to exam type of questions. Exam type of questions, what we can expect at the final level. Final level, you are coming from inter, so you are supposed to know activity-based costing, traditional costing, and now in final you have learned target costing. So I can have a combined question of 10 marks or more, which is comprising all 3 of them or any 2 of them. So I can ask you traditional costing and target costing comparison. I can ask you ABC with target costing combination, or I can ask you all 3 put together. Traditional costing statement, that is absorption costing statement, then activity-based cost statement, and a target cost statement. All 3 can be asked. Okay. So now we will take up 2 questions. One which is giving you the question where you have to prepare the ABC statement. You have to prepare target cost statement and compare. Then we have the 5th question where we are going to have all 3 taken together. and a decision to be taken as to which technique of costing to be applied for which product. Okay, so let us start with question 4. X Limited is engaged in the production of 4 products A, B, C, and D. The price charged for the 4 products are 180, 175, 130, and 180 respectively. Market research has indicated that if X Limited can reduce the selling price of its products by 5, it will be successful in getting bulk orders and gain a significant share of market of those products. The company's profit markup is 25% on cost. So mark that. Company's profit markup 25% on cost. The product relevant information of the products are given. Output is given in units, cost per unit is given, direct material, direct labor, and machine hours per unit. The 4 products are usually produced in production runs of 20 units. So one production run will produce 20 units and sold in batches of 10 units. One batch is of 10 units. The production overhead is currently absorbed by using a machine hour rate, absorption by machine hour rate. And total production overheads for the period have been analyzed as follows. Machine department cost 52,130, setup cost 26,250. Then you have 18,000 of stores receiving, inspection, quality and control 10,500, and material handling and dispatch it is 23,100. The cost drivers to be used for the overhead costs are as follows. For setup cost, your cost driver will be number of production runs. Whenever they use the word cost driver, it means ABC is going to come. Okay, so ABC costing is going to be there. Number of requisitions raised in the stores was 100. The number of requisitions, driver, cost driver rate is given 100 for each product, and the number of orders executed was 210. Each order being for a batch of 10 units. Batch of 10 units. You are required to, what they are asking you, compute the target cost for each product, as I told you. Second, compute total cost of each product using activity-based costing, ABC, and compare target cost and activity-based cost of each product and comment whether the price reduction is profitable or not. Okay, so let us start with the first statement showing target cost. Statement showing target cost. Four products are there. Present price is 180, 175, 130 and 180. It is proposed to reduce the price by 5 rupees per unit. So the proposed price will be 175, 170, 125, 175. Now, how to calculate target cost? Proposed price we know, but a proposed price is cost plus 25%. Proposed price is cost plus 25%, which is equal to 125%. Correct? So if I want to calculate cost, what do I do? 175 divided by 125%. 175 divided by 125%. So calculate 175 divided by 125%. I think you'll get 140. Correct? 170 divided by 125%. 136. 125 divided by 125%. 100. This will be 140. Done. Let us go to the next statement now. Statement showing activity-based CDR, cost driver rates. Okay, activity-based cost driver rates, CDR. Activity-based cost driver rates. Bracket you write CDR. Activity amount, cost driver, cost driver quantity, cost driver rate. CDQ is cost driver quantity, CDR is cost driver rate. Let us write down the activities. Setups, stores receiving, inspection, handling and dispatch, Last one, machine department. Write down the amounts now. This is 26,250. Stores receiving is 18,000. Inspection is 10,500. Handling and dispatch is 23,100. And the machine department is 52,130. Cost driver for each one of them. For setup, the cost driver is number of production runs, stores receiving, it will be number of requisitions. All this is given to us. Inspection will be number of production runs. Handling and dispatch, number of orders. And this will be machine hours. Now, let us give working for each one of them. Number of production runs. What they have mentioned. See, what they have said is the four products are usually produced in production runs of 20 units. How many units are produced of A? 600. In each production run, 20 units. So how many production runs? 600 divided by 20. For B, it is 500 divided by 20. For C, it is 400 divided by 20. And for D, it is 600 divided by 20. Okay. So let us do that. Number of production runs. 600 divided by 20 plus 500 divided by 20 plus 400 divided by 20 plus 600 divided by 20. So this will come to 30 plus 25 plus 20 plus 30. 60, 80, 105. So 105 runs. Number of production runs 105. Second is number of requisitions. $100 per product. For 4 products, it will be 400. $100 per product for 4 products, 400. Machine hours. How to calculate machine hours? Machine hours per unit is given. 4, 3, 2, and 3. This will be multiplied to 600, 500, 400, 600. So 600 into 4, 3 into 500, 2 into 400, 3 into 600. Machine hours. 4 into 600 plus 3 into 500 plus 2 into 400 plus 3 into 600. So 2400 plus 1500 plus 800 plus 1800. 6500. Number of orders they have given to us 210. So now divide 26,250 divided by 105. Total amount, that is, what is the formula? Cost pool divided by cost over quantity. Cost pool means total amount. Cost pool is 26,250 divided by 105. So that will come to 250. 18,000 cost pool divided by 400 requisitions. So that will come to 45 per requisition. 10,500 divided by 105, so 100. 23,100 divided by 210, 110. 52,130 divided by 6,500. 8.02. Check. Are you getting the same figures? Now let us with the statement of cost using activity-based costing. Okay, statement of cost using activity-based costing. Starting with direct materials. Take the per unit cost of direct materials. 40 into 600, 50 into 500, 30 into 400, 60 into 600. Per unit into number of units. We are taking the direct materials. So this will come to 24,000, 25,000, 12,000, 36,000. Direct labor, same way, per unit into number of units. 16,800, 10,500, 5,600, 12,600. Setup costs. Setup cost rate is 250 per production run. So 250 into 30. Now you are having the figures here. 250 into 30, 7,500. 250 into 25, 6250. 250 into 20, 5,000. Like that you go on multiply. Setup cost 7,500. 6,250. 5,000. And 7,500. Stores receiving rate is 45. Number of requisitions 100. So 45 into 100 for all. Stores receiving. Inspection. $100 per production done. So 3,000, 2,500, 2,000 and 3,000. 100 per production done. So 3,000, 2,500, 2,000 and 3,000. Materials handling. Materials handling. 110 per number of orders. 110 per number of orders. So 110 into 6. 5,500. 4,400. 6,600. Calculate a machine cost. $8.02 per machine hour. So first one will be 19,248. $12,030. 6,416. 14,436. Total cost. Calculate the total cost. Okay, give me the figures of total cost. First one is 81,648. Second one 66,280. Third one 39,916. Just check the figures. Last one 84,636. Check the figures. Calculate the cost per unit. Total cost divided by output. Calculate up to 2 decimals. Eighty-one 648 divided by 600 will be 136.08. 66,280 divided by 500, 132.56. 39,916 divided by 400, 99.79. 84,636 divided by 600, 141.06. Now, cost per unit as per ABC and the target cost per unit. Let us compare. Target cost per unit means maximum it should be 140, 136, 100, and 140. Maximum. As per ABC, 136.08 within the limits. For product B, 132.56 within the limits. Product C, 99.79 within the limits. This is less than the target cost. So when you have less than the target cost, what will happen? Your profits are going to be more than anticipated. If your actual cost is less than, your ABC costing is less than the target cost, that means your estimated profit is likely to be more than what is expected. So last one, if you go to see 141.06, which is above the target cost, not required. I mean, it is not going to work out because that will reduce my profits, estimated profits. So except for D, products A, B, and C, we can reduce the price by 5 rupees and arrive at the target cost price. There is no problem because as per ABC, the costs are going to be further less than what we have targeted. So that indicates more profitability, higher profitability. But for product D, there will be a problem because the actual cost is slightly more than the target cost. Therefore, the company should reduce the cost, control the cost. What is the option? Redesign the product, okay, thereby reducing the cost of the product. Let us write down now. Below the statement, write comments. Comments. Below that, right? Actual cost of products A, B, and C. Actual costs of products A, B, and C are well below the target cost. Are well below the target cost. Full stop. Therefore, there is no problem. Therefore, there is no problem in reducing the selling price of these products. In reducing the selling price of these products by 5 rupees. By 5 rupees. It will help in increasing the profitability. It will help in increasing the profitability of the company. Stop. However, in case of product D, the actual cost is slightly more than the target cost. The actual cost is more than the target cost. Therefore, the company should either control the cost. The company should either control the cost or redesign the product. Or redesign the product. Okay. Any difficulty? So we have got an idea as to what type of questions they can ask. They can ask you simple questions of 4 to 6 marks, calculation of only target costing, or as I said, full-fledged question like this, which has been asked in the examinations, as you can see, where we are doing a comparison of target costing and ABC here. The next problem that we are going to do is going to have 3 methods: traditional costing, ABC, and target costing, and comparison of all 3. Okay, we'll stop here for today. Tomorrow we continue same time, 7 o'clock in the morning, 7 to 8:30. Okay. Have a nice day. Bye.
Thank you, sir.
Thank you.